Hi, thanks for tuning in. We have a market update for you. We're going to be doing a little bit of a recap of the macroeconomic situation going on in the country, and then we're going to get down to the state level. And we're really excited to be teaching this. We're really hoping you're going to get some good value in there. There's a lot of really good slides that'll help you understand kind of where we've been and where we're going. And of course, I got my friend and peer here, Anthony Meisner, and my name's Tucker Brock. Let's go ahead and dive in.
Okay, so let's talk a little bit about consumer sentiment, where we are, what people are feeling in the economy, right? We're going to start really macro level, talk national only today. Here's one that I think is really important, right? As we look at consumer sentiment and everything has been kind of falling, where are we compared to, this goes all the way back to 2000. We're at the lowest consumer sentiment levels and projections that we've had, in basically my adult life, right?
Yep.
So that's a really interesting fact. The other thing too is when you look at like the Warren Buffett ratio, we like this because it evaluates how either overvalued the stock market might be or like what investors are thinking when they're looking at things. This also tells you that sentiment, even in the investor market, is not as good as it should be.
Yeah, and you can see that we've just had a really high valuation right now in the stock market, and we've been hearing that for a couple of years.
Mhm.
So we're going to see what happens this year, but hopefully the shoe does not drop.
Absolutely. All right, let's
Okay.
talk about debt versus GDP, Tucker.
So this is a really important one to look at. Why do we want to talk about this? Because, well, once a government starts spending more and more and more than they make, normally that ratio is about 125% of debt to GDP. Once you hit that ratio about 120 to 125%, we start having what they call the death spiral, where it costs so much to pay the current interest and refinance the current amount out there that we start paying more in interest than we do actually towards the principal, and then we just have to keep building that debt. So it really can hurt us long term and degrade our credit, which happened last year. We went from AAA to AA, and that just shows, hey, that means it's more expensive for the country to borrow, and that's because they look at these ratios.
Well, because we're actually at 120% from debt to GDP.
It's not good.
The other thing that is concerning here, it's not necessarily concerning. We don't really have the updated data from the last quarter. Keep in mind the government shutdowns affected things. Fred was one of them where data is really lagging right now. So apologize for that, but really nothing we can do about it.
And so when we're looking at this 10-year Treasury bill versus mortgages, I think it's important to look at how these 10-year Treasuries are constantly maturing and why do we care about that 10-year, right? It leads to mortgage rates, right? That is the best indicator of mortgage rates. And we can see it's been sitting right above 4 to 4.2, really kind of hovering in between there. If we can get some good long-term policy put in place, that will help bring that 10-year Treasury note down.
All right, so 4.2 for the Treasury, which really equates to a 6.1% interest rate, right? And you can see where that's sitting today. Those slides are interchangeable. We really put both of them in there just more for you guys if you prefer one or the other when you're talking with people. The big thing that we also watch and that a lot of economists are looking at is what's the difference between the 10-year and the 2-year, right? And which one's higher, right? And when the yield curve gets inverted, it's a really good indicator of recessions. And so all those gray bars down at the bottom, that's, as long as they've been tracking this throughout history, you can see basically when the yield curve goes down below, so the 2-year is actually less valuable than the 10, then we see recessions happen. And we actually went through a huge cycle of this recently. And, what they're talking about, soft landing, all these things, appears to sort of be the case. It's tough, though, because it's almost like we have a silent recession in so many ways. And we'll kind of talk with you a little bit about that and how that's affecting things. But as of right now, a true recession is measured by 2 quarters consecutively of negative economic growth, right? That's what we experienced during the pandemic for a quick minute. And we really hadn't seen one since '08. So, maybe this is a positive thing.
Yeah, it is a positive. And now this is something that's concerning for a lot of us in the real estate market. People are not saving like they used to. Right now, your personal savings rate is based on your discretionary income. So it's a weird formula behind it, but it's really just showing how much are people saving. And we saw what folks did back in 2020 when we had those government checks come out, massive saving rates. People couldn't spend money. Everyone had money for
when you
these
couldn't
down
leave your
payments.
house and you got a bunch of money, that's what happens,
Yeah.
right? You put it in the bank.
But people had money for down payments, renovations, all this real estate transactions. Now you look at it, people are only saving 3.5% of their discretionary income. That is very
like
concerning.
basically nothing.
Yeah, so what that means is folks are not saving up for those down payments 3 years out, 5 years out, and that's a big concern when we're looking at it historically.
Absolutely. And if you look at M2 is the supply of money out in the marketplace. So this is $22 trillion of liquid assets and money floating around, right? So this is anything you can use. Now, the interesting part is, we saw the pandemic, you saw the recession, we printed a ton of money, clearly, right? Money supply through the roof. And then
look at that lower graph on the right. You can see that vertical line.
History.
That is money being printed and put into the market.
If you look at the top, it still shows on the top there. And if we actually printed about $3 trillion in the course of a matter of a few months. So that was just money supply active out there, which really re-stimulated the economy. Then we continued to print money because we thought that was a good idea at the time. And now here we are trying to catch that ball as it drops and create no more inflation. So as they're trying to get money supply under control, you can see kind of what that's looked like over the last few years. But truly in the last 2 years, it's not like we've slowed down the supply of money. We still keep increasing active money in the market. And that just creates inflationary problems. It creates all kinds of issues. So as you can see, I'm not super optimistic, if you can't tell from what I'm saying, about the supply of money in the marketplace. It does really need to be restricted.
And you can see what they did with the quantitative easing, when that little dip is, right, starting around mid-2020. Remember, that's when rates changed.
Yep.
That was also led by monetary supply being changed by the Fed, which, hurt mortgage rates.
All right, so let's talk about per capita income. And of course, because we're standing here in Boulder, we talk a little bit about Boulder County, obviously being Colorado. That's a really good perspective for you to have. So every one of these charts going forward, when you see the three colors, dark blue is the US, green is Colorado, and the dotted line there is Boulder County. And you can really see, a lot of these indicators lag, but you get the difference between, we talk about this because, higher income means higher housing prices, higher affordability, right? But the real issue is the gap between US and basically Boulder or Colorado isn't nearly as much as the gap in the housing prices, right?
And so what Anthony's really saying is the difference between, hey, our median home to that blue line for income compared to what it is for Colorado and compared to what it is for Boulder County, it gets much higher. So it's not a direct, we don't make enough to justify our median sales price in Boulder County as a median income. And I think that's just an important thing to note is it's not equal across, the different regions. It changes a lot.
Absolutely. And a lot of this is largely due to the fact that we've had such low unemployment rates for so long. We have large wage growth, right? And this happened all the way through basically, the last decade, especially post-pandemic time or post-recession times. And you could see Boulder County and the state of Colorado, they really tend 90s, 2000s, 2010s, every decade, we really outperform the nation. The unique thing that happened recently, and this is very concerning, is that Colorado and Boulder County have had higher unemployment rates than the nation up until basically the last period.
Yeah, and this is really unusual for us as a market. And I think that also is just a bigger indication of, like Anthony mentioned, there's a silent recession going on. Some folks have called it a K-shaped economy. There just seems to be pain at different points in the economic and the socioeconomic kind of bandwidth. Folks in the different median brackets of income, there seems to be a lot of difference between those brackets, and that's really hurting affordability for, the 60% of the lower half of the tax base, the 60% or 80, even really 70% less of the tax base. Their median income doesn't match the median home sales price, and that's where we're hearing this affordability issue.
Kind of put this into perspective, let's just look at a slide from NAR. This tells you in thousands, like what the monthly job change has been. And you can see over the last 4 months as they've been reporting this, really even a little bit longer, that has been really, really nominal, right? There's just not a lot going on there. So you can see not a ton of job creation, which is what makes me use words like silent recession. This is interesting though. So this is job gains since the pre-COVID, record high payroll numbers that we had. Mm-hmm. So much of the economy across the nation, look at the Northeast, look at the Western slope, they've really not done anything, right? Like those 3% numbers are, that's pretty tough over a 5-year period. Now, Colorado, 6.6%, I think that's worth noting. And then, of course, there are definitely economies who have done well. The South is looking remarkably well, right? Florida's the high at 11.3%. You got the Carolinas doing well, Texas is doing well, and Idaho and Utah, for one reason or another, seem like there's been a lot of job increases there. The worst one in the entire nation would be Washington, D.C. It is absolutely worth pointing out, even though it's a metropolitan market, it's not in the state. it always gets measured separately, and minus 5.4% is a little tough.
And why do we care about jobs? Jobs equal housing,
They do.
right? Jobs equal housing, job equal buyers, they equal sellers. That's why we care about jobs and track jobs.
We do. Think about it. I mean, you're not going to buy a house. You're still going to be living at home with your parents if you don't have a job, and that's just the reality of it. So multi-generational housing becomes more and more of a concern as job growth doesn't happen.
Okay, so this is really important. And the reason we want to take a little time to talk about this is understanding what does the Fed actually do and how does it impact me, you, and our daily lives, and also business, which then affects our daily lives. So the Fed's true goal is to promote maximum employment with stable pricing. So their job is to keep employment and inflation under control. We want to have high employment
with low inflation.
But it doesn't always work that way because those things can be counter to each other in economics. So they balance the two. And how do they change that? Well, the Fed funds rate isn't the long-term debt rate, right? This is one-day lending between banks. So banks have all these regulations of how much they have to have on deposit for whatever's going on. Hey, a big set of money moved out for a transaction. Well, we have to have enough reserves. So they borrow the money overnight from the Fed, go, hey, we will pay you your Fed funds rate for the money overnight. This is the interest rate that sets our credit cards, our HELOCs, and anything that's adjustable, right? Really anything that's adjustable. Mortgage does have a little bit of a different margin because they're 7 then plus year ARMs. But really for our day-to-day lives, the Fed funds rate is affecting our day-to-day spending on credit cards, HELOCs, and those short-term debt instruments.
I do want to say, I want to thank our friends at Guild Mortgage for putting this together because we borrowed this slide with a few other things in here to kind of make this point. So
thank you, Guild.
As we move on, let's talk a little bit about what the Fed is actually planning on doing, right? You saw the stoplight. There's a lot of numbers there. Basically, at this point, we're still in the zone of like, things don't look great. We're just kind of shut off the flow of money. Now, has it come down quite a bit? Yes. Now, the interesting part is this is a future cast. So all the Fed members have to put a vote out and they put their long run estimates of what they want to see and what they think it needs to be. And this has changed really dramatically in the last 2 years since we've been putting this presentation together. And the Fed put this together in December. So this is fairly recent numbers. And you can see that the bulk of the Fed members don't really have a great idea of what's going to happen in 26. They all are sort of kind of coming down to that 3% mark over time. But I think what this tells us is banks are going to continue to borrow money at a very similar rate to today, right? Maybe a half or a quarter point less over the course of the year into 26 and into 27. It's not going to get a whole lot more than that. So you can really see, and these are by the end of the year, right? Mm-hmm. So as you start to see the cost of money slowly creep down, it's not like you can just wait around for interest rates to drop because is it slightly correlated to the 10-year? Yes, right? But it's absolutely not a direct representation. But when banks can borrow money for less, they're willing to lend money for less, right? So that's generally how this works. Let's talk about housing now. I think, we've talked a lot about the macro economy. What's going on in housing nationally? So this was the NAR forecast for the year.
Yep. And so NAR is very optimistic on this. They think nationwide we're going to have a really good rebound year, right? Existing home sales up 14%. New home sales, 5%. That might be a little bullish just because the inventory hasn't been getting built quick enough because there wasn't enough sales in 25. They delayed building until the old ones or the ones they already started sold. Mm-hmm. So hopefully we'll get to that number. Then I think this is a really key thing is the median home price increased 3% last year. They're anticipating 4% this year. That doesn't mean it's going to be the same here in Colorado because we've had a lot more real estate gains over the last 15 years than most of the country. So the rest of the country is going to be bringing up that median to balance out where we've kind of gotten to.
So 2 million job gains is why they put this in parentheses here is sort of our standard, right? That's what we need. We had 400,000 job gains in 2025, which was abysmal, which is why you're now seeing so much pressure being put on everyone to try to reinvigorate the economy, right? Unemployment rate is sitting at 4.5% or 4.3%. We expect that to stay fairly same. Sure, more job growth will help the real estate market. Well, let's kind of look at like where we are, right? I mean, this one's super fascinating because For basically a decade, we transacted between 5 and 6 million homes for a long time. And then the pandemic happened, obviously, where we had way too many homes selling, way too much demand out there because money was so cheap. But we really have not rebounded for 3 straight years. It's been very stable, very rock solid. What they're basically trying to tell you is eventually people are going to have to move a little bit, but it's just not going to be that much better, right? A 10% or 14% gain, according to NAR, is really still going to put us right there in that 4 to 4.25 million range. It's just not enough to really get back to maybe necessity for the consumers out there.
And it really just shows the overall deal volume out there is much lower than it was several years ago. And then even over that 2015 to now, that last decade, 7 of those years we had great gains. The last 3, we were just going through a different cycle, right? Real estate is cyclical. It's just time until we start building back up. But whether that's 1 year to 3 years, we just don't know.
True. Okay, so let's look at median sales price, average sales price, and then that dotted line would be your all transaction housing price index, like the cost of housing. The interesting part is, we've been reporting this since, 1965 or whatever. And Fred really gives us the ability to track this over time, which is cool to see. But what we have noticed is even though housing prices have sort of stagnated in the last 3 years, the affordability is not getting any better.
And that's where we're feeling it from the taxes and insurance and other hard costs, HOAs, metro districts. That's where we're feeling those other costs getting passed through to the consumer and the buyer. That is also hurting their affordability. So it's not just mortgage rates, it's all the other pieces that go into it. And I know here locally, insurance is a major one, right? Insurance doubled or if not tripled over the last 5 years.
Most of the nation, right?
Yep, even the most of the nation, but it's tripled in the last 3 years. So what was $2,200 is now $6,000, $6,500 for insurance on the same house. And that is just a hard cost that just keeps building, which then lowers our affordability.
Okay, so let's talk about supply of listings. These are like, the boxes we need to check to really know what's going on, right? You can see Colorado being the green line and the nation being the blue line. Usually, Colorado operates at a much lower inventory level than the rest of the nation. It's a unique time since the pandemic because we've had more inventory because housing prices went up so fast that now we have inventory really starting to stagnate and sit on the marketplace. New listings coming to market tells you how much sellers have demand, right? Mm-hmm. And what you can see in the last 3 years is sellers in Colorado are more apt to sell homes or more necessity to sell homes than the rest of the nation. So even though they had lower interest rates, there's plenty of reasons that they might need to move. That's a huge change, right? That's a huge shift.
Yeah.
But what about buyers?
And so this is the key pieces, right? We love high inventory. That means buyers have a lot of choices. But if we don't have enough buyers, then those houses sit. And that's what we experienced last year here in Boulder County.
Prices, right?
And it drops prices and people are having to give away the farm just to get rid of a house. And so this is the key piece to follow is we're going to have another high supply year, right? We know that. We're already seeing it. Mm-hmm. The question is will the buyers come out? And so I think looking at demand across this is as we're looking across the United States, then, this county, Boulder County is way there at the bottom. So it's kind of hard to track. But just looking at Colorado and Boulder County, we can see how high our demand was, both nationally and locally during the pandemic and even prior to the pandemic from, during those late 20-teens years where we had a decent market going forward. And now you can see where we are. We're just so much lower as a country in demand. And a lot of that's those affordability index that is showing that's what's hurting these buyers. So we need to figure out a way to make it more affordable for buyers, whether that's through insurance or taxes. We need to figure something out to help juice first-time home buyers and get millennials and what's the generation behind us?
Gen Zs.
Zs back into houses and to start actually thinking they can get a house because that consumer sentiment plays into it.
This is supply from new builds. It's actually dropped by over a month in the last few months, which is cool to see. But the big issue here is that there's too many homes that are new on the market that are now unaffordable or harder to purchase, right? So they're having this issue where we're going to stop building homes because there's so much sitting. So we create less new inventory, which is really an issue because the population is still growing, right?
We need more inventory.
We do. Yeah. To give you some perspective, this is how NAR put it. Out of every 1,000 residents in the United States, 14 people actually are purchasing a home in the next year or in the last year, right? And that tells you a lot about where that was. Back in 2020 or 2005 was at the highest it had ever been. You had like 27 people. And then basically during the pandemic, we saw these huge rates over 20 again. Where should it really be? I think a good example of this is back at that 5 million mark, we'd be at about 16, 17 people instead of basically 14.
Yeah.
So it's not that many more per thousand, but it's a lot more than we have currently. Here's the thing. Where are people buying? Who's actually purchasing? Who needs a mortgage is also the other question in this. It's interesting because baby boomers still show up on this list quite a bit at 12% of all mortgages taken out. But in all reality, the baby boomers are the ones with more cash. So a lot of them have already owned a home outright. They're actually going to be able to sell something because they don't have a mortgage and go buy something without a mortgage.
That's the downsides we're seeing all over the place, or folks wanting to downsize.
It's true.
But when we look at this, we see millennials, right? That's us. We're the number one people taking out new mortgages right now for origination. And that's a really good sign to see this cohort of age getting finally into the real estate market.
Yes.
Because they, for the long time, were way behind in when they started their life transition into buying a house and settling down and all of those pieces.
Well, and you have a lot of Gen Zers that should be home buyer age, right? But they still only represent 16%.
And that's
so we are behind the 8 ball. Right?
We are, and it's just taking longer and longer for the next generation to want to buy a home and do those next life steps. And that's where we see millennials are finally doing it. But it's a big piece that we need a lot more of those first-time home buyers from Gen Z.
We do. Check out this. Look, under 35 crowd, this includes millennials and Gen Zers. They only represent 39% in 2025 of people that actually owned a home ownership rate, right? 36% prior to that. You can see that, the 35 to 44 crowd finally really starting to actually get in there, but still way lower than, the average rate. And you can see as people get older, they tend to own a home. They're a little more stable. Ideally, we want to see that rate in, that 70 range all the time.
Yeah, and it's just amazing how much of a jump there is between over that 35 number.
I mean, it's wild right now. This is not always what we want to see, but we are finally seeing some participation. The interesting part, though, is out of everybody, taking out a mortgage, first-time home buyers are representing 59% purchases in the mortgage market.
Yeah, and that's a really good sign because it means folks are getting into it, but it's also a sign of people downsizing out of those larger houses, and downsizing. Hey, they don't need a mortgage. So that was that baby boomer number as well, because they already have that equity to be rolling into the next one. So it's a good sign to see that this is increasing.
It is a good sign.
But we still want to see people moving as well, because this means that we're not getting loans from people upgrading their home or downsizing and getting a loan.
So this one shocked me. What's holding consumers back from buying right now? And so many of them have a lot of opinions, right? Everyone in the real estate industry would be like, oh, maybe it's a job stability, or maybe it's, mortgage rates are too high or whatever. But in all reality, it's just that they don't have enough money up front. And why is that happening? So when they dove into it, number one, there's a big myth
Let's
around.
Go back real quick. I just have to say closing costs includes your down payment. Very key to see that. That is the down payment. That's why this is important.
I know you're very, very stuck on that one.
I know.
But the reality is that there's a lot of myths in the marketplace. People still think, millennials and Gen Zers both, that 2 in 5 people believe you still have to have 20% down on a house, which is absolutely not required. But look at what it actually costs to put down. Back in 2020, you needed about $25,000. You could go out and buy a house. It was pretty normal. That was the median down payment going out there. That has increased almost threefold since then in 5 years, right? And actually it probably is threefold if you look at it in the last year as well. So 2.7% change, you go from 25,000 to almost 70,000. How many people, especially at 35 or 38, really have $70,000 sitting around if they've been a renter before, right? So this is why we're seeing so much help from older generations. This is why we're seeing people wait longer and longer to be able to purchase. Yes, there's a lot of ways to not have to put that much money down, but I mean, taxes have gone up, insurance has gone up. You have to put more into all kinds of different things, right? So this is a pretty challenging.
And this is just a fun question to the folks viewing this. Did you save $45,000 between 2020 and 2024? Because that's what it would take. That's how much these people would have to save to then be able to afford if they waited to buy.
The wait to buy thing really killed a lot of millennials, right? And so if they bought in the pandemic, they're in a good spot, even if their house is basically worth the same as it was before, because they have a lower interest rate. They didn't have to put as much down, and clearly they got on the escalator, and that's a good sign. Now, this one I just put in here because I think it looks interesting, and it was really fascinating. So what are we looking at?
So you can see where are we seeing gains in prices, where home value is changing. What we're seeing is the Midwest from mid to, all the way up to the border,
Yep.
Northeast, all are doing really, really, really well. What you can see in Colorado is we have a little bit of a down arrow, and that's because we're losing a little bit of home value because we increased so much more at such a higher pace over the last 15, even 18 years compared to, the Midwest, the upper Midwest,
Well, it's largely due to the
Northeast.
pandemic changes, right?
Yeah.
Colorado went up 40% in 2 years, where the Northeast might have increased by 20% or less. So it's a function of affordability at this point is what's happening. And migration patterns have completely changed because housing costs got too expensive out in the West and in the South. And all of a sudden, you're seeing them move back north.
Mm-hmm.
This is why I kind of put this in there. You can see Colorado being one of the worst states at 45% in basically the last 5 years. Some of the top states, though, are still some of those where, the Northeast, obviously, very clearly. Maine is 80%. That's a wild number. Montana, 70%, right? Places that had cheaper housing have had the ability to go up more in the last 5 years.
Yep.
Places like Hawaii, very expensive state to live in, very similar to Colorado, right? You can see that. And, up on the west, like the South is a good example too. Way higher appreciation rates because housing was cheaper and people have had to move to where housing is a little bit more affordable.
And that's where we've personally seen folks we know move to the Midwest because it's cheaper to have a family.
Absolutely. All right, so let's talk about showings. This is the last thing we've got for you today. Thanks for hanging in there with us. But Tucker, what do we look at with the showing?
So what we're really seeing is we like to compare the West versus the United States. West is, as you can see down below, a lot of folks in that region. We're not seeing the same amount of showings, and this is what I was mentioning earlier. We need the buyers to get out there showing. This is really what is going to drive our market this year is what's going on with the buyers. And we can just see the West is still below the national showing averages compared year over year. And the reason why is because of that affordability. The West is still more expensive. We had that massive run up in prices. Now we saw that migration back east a little bit, back to the Midwest, Northwest, South. And that is really what's pushing their prices up, and ours are falling because we do not have the same net migration.
You look at it by what's happening in Colorado as far as showing is concerned, off to a really great start this year, some really big showing traffic out of the gates, and it's slowed down a little bit as weather's gotten a little colder, but part of it is definitely weather. The other part is people have waited for a long enough time that they just are out and active. So this is why NAR said 14% more. Mm-hmm. I think we're looking at 7 or 8% more on our projections. The range there from between Moody's and NAR at this point is wildly different. But there are definitely pessimists in the market that think it's going to be exactly the same. I think NAR was actually the highest this year at 14%.
They were.
And usually they're not. So that's kind of your range. I think showing traffic indicates that we definitely are going to see more buyer activity locally, which is awesome for all of us. I think that's great news so far.
You can just see, it's hard to tell on that graph, but you can see if you really have good eyes. That cold weekend, it just dropped.
Yeah,
so it just shows how much weather is a part of showings and people going out and taking a look at houses.
Totally.
It's kind of funny.
Well, thank you for joining us today. Obviously, we're Anthony and Tucker with Land Title. We really appreciate you joining us. Reach out to us with any other data needs, right? We're here to help you with your business. We're here to help provide stuff that's going to help you win listings, help buyers. So thank you for joining us.
Appreciate you tuning in, and we'll talk to you soon. Thanks, everybody.